Once we have all that information and we have the underlying risk quantification in the background, the insurance analysis becomes relatively simple. You can see here the risk transfer analysis, because often what you hear is that if you have a certain risk, high level of risk, you just need to make a decision around to what extent you will transfer that risk to someone else as an insurance provider. However, transferring is not as simple necessarily. There's no free lunch in transferring risk, as you can see here in a second. What the risk transfer analysis highlights is that there is a certain expected payout for this specific coverage, which is represented by the green area within the chart. This basically means that considering the loss exceedance curve of this risk event, then to what extent the insurance policy, considering the coverage limit, is going to pay out some of the impact from this risk event. However, in order to get access to that potential transfer of risk, you need to pay an insurance premium or an insurance cost or fee upfront to the insurance provider, and that is represented by the red area within the chart. And then if the red area within the chart exceeds the green one, that basically means that in that part of the risk profile, the annual upfront cost exceeds what the annual payout would be. So in this case, the expected annual payout is a little bit less than the annual upfront cost. So the expected excess payout is a little bit negative, but close to zero, which basically would represent that the insurance policy is priced at a fair value, because zero would be the fair value, in which case the expected annual payout is approximately the same as the annual upfront cost. Of course, this is on an expected basis, so there is the Monte Carlo simulation behind it. However, every year could be different. And related to that, there is the excess payout likelihood information that can be very relevant to consider. This shows here, in this case, for the specific risk event, that there is only a 38% chance or likelihood that in any given year, the insurance provider will pay out more than the fee that is paid for that specific insurance. However, even though it is a relatively low chance for an excess payout, the amount of excess payout could be pretty significant. It is because the cost of the insurance is $13 million, while the potential maximum annual coverage is $50 million.